Hello and welcome to another lesson. I hope you are well. Now, we have spoken before about divergence in price, or S&T divergence, if you want to call it that. And if you go back to the last lesson, it will be a very good lesson on, or the last lesson a couple of modules ago, with regards to divergence and just the introduction to it. You'll see exactly why and how. And we're going to kind of repeat a few different things on that. However, we're going to go deeper because divergence is generally one of the most powerful tools to help us get into the market. So, just as a recap, if price action on one pair is doing, if price action on all three particular pairs that we're looking at is doing the same thing, price action is moving in tandem. Now, why have I got three particular pairs rather than just two as taught in the last lesson? That's because we are utilizing three pairs in the way we trade. So this here is going to be the NASDAQ, just as an example. And this one over here is going to be the S&P. And over here, we're going to have US 30. And if you're trading on Forex, again, this would be your euro. In fact, I won't do Forex yet, but basically it'd be Euro USD, it would be pound USD, and it'd be the DXY. The reason I'm not doing Forex yet is because price action moves slightly differently. I'll go over that very briefly in a minute. But what we're looking to identify is areas of liquidity in the market. Now, for example, liquidity, you can see very clearly in this situation, is being taken on all three particular areas. Now, if we go down to, and we just move this along to talk about divergence, but this time actually, we're going to swap this over because now what we actually have are three pairs, but an inverted pair as well. So that therefore will be, this one will be the DXY. And this one is going to be GBP USD. So this is Forex. And then over here, we're going to have Euro USD. So again, on Euro, if we've got this area of liquidity, the same height we want to be focusing on pound. And then we want to be focusing on the low over here on the DXY because price is invertedly correlated. So there's a difference that we have to try and understand. But let's just focus back onto the NASDAQ for a second and the S&P and the US 30, the indices. If we find a situation where the NASDAQ has not swept the high and started pushing to the downside. So if we get something like this, which is actually happening, we have divergence in place as explained in the previous video. Again, go back if you're very, very unsure. If this is the first time you're looking at divergence, go back and watch that video on one of the other modules with regards to divergence because it's going to explain a lot more. But we're just going to talk more about the deeper roots in terms of what divergence actually is. Now, if we find an entry, and the entry can be anything, I don't want you to worry about the entry right now, but if we find an entry on any of these three pairs, essentially you've got a play after you see this particular area of divergence playing out. So for example, if a fair value gap or an inverse fair value gap creates itself and after divergence has played out, that is a very, very strong confirmation of an entry, especially if this divergence is happening within a higher time frame point of interest. So it could be a daily fair value gap or a 1 hour fair value gap, whatever it is, it's your higher time frame point of interest. If you get that divergence, then the fair value gap inside a point of interest, along with the break of structure and everything like that, that is an entry in the market. Likewise, if we go over to Forex and you see as an example that the DXY has not swept the low, but has started pushing higher, as where over on euro, we've started pushing lower, and on pound, we've started pushing lower. That is divergence once again. And if you see another entry method within this area here, perhaps here or even over here, you're not going to trade on the DXY, you have got an entry in place because there's an inverted crack in correlation. Likewise, if we, for example, on the DXY, we swept the high, but on euro, we didn't, again, you would have an entry, but you'd still be taking the entry on euro. Now, when we have, let's say we've got three perfect entries in play, the highest probable move would be the pair which has not swept the high. Let me just say that again. The highest probable move would be the pair which has not swept the high, because this pair here is showing a higher relative strength to the downside, as I explained in the last video. Again, if you need to go back and watch it, please go back and watch it, because this isn't just going to be a lesson here on divergence. This is going to be a lesson now on the type of divergence that we're actually looking to see within this area here. So to make things a whole lot simpler, what I want to actually do is bring you to a live chart example. And the reason I want to bring you to live chart examples is because it's all about the type of high that we're looking to engage with. Because you can see here, this high, we swept above. This high, we swept above. And then over on the same high over here, you can see on a weekly time frame, there was a crack in correlation. This was around about the time Donald Trump came into market, into office, and we saw this huge push to the downside. Coincidentally, everyone thinks it's tariffs, everyone thinks it's Trump, everyone thinks it's all the world events. Divergence was in play right before it happened. There was always going to be a break lower, sweeping all of this liquidity that you can obviously see playing out. Such powerful stuff. However, let's just take a second and focus here on what exactly this particular high is, because if you were to gauge, and we're going to a daily time frame to make lighter work of this, but if you were to gauge the high on the second, this is the start of December, and now we go to the end of December, and then I want you to focus on the end of January, and then I want you to focus on the end of February. Vice versa over here, we've got the same situation playing out. So again, we just bring that all the way. This here is where it gets super, super powerful. And I'm just going to draw it in front of you because I feel like that's the most powerful way to basically help you understand. Because when we talk about divergence, we're now, and this is the thing, when I talk about quarterly theory, we are not trying to get the accumulation, manipulation, all that stuff. You can see there's a difference here, but the actual run here, I want you to focus on this for a second. Because this here is a high that was created in December. This was the high of December. And then we have January. Notice on your chart, and this is the same high which happened in December here and vice versa over here. January did not sweep December's high, but it did on S&P. Over here, January, December's high did not get swept, but it did on S&P. If we And again, just for the sake of clarity, if we just bring this over to February, the high that was created between January and February, if we look at what actually happened here, because you will see the high, we created a high in January on the US 30. We did not sweep above that high in February, but over here, we swept above the highs over here. So this is timed divergence in price. This here now is where it gets interesting, because the divergence that you see, we want to happen in between cycles. So we want these areas to create divergence between the highs that are created in the cycle. So this would be your monthly cycles: December, January, February, December, January, February. Again, December, January, February. We had divergence between consecutive months. Now, for reference, if I just draw something to make it a little bit easier, just to get you to understand a little bit more, if we go and build our quarterly theory box, what we're actually looking to do is, and for the means of not overcomplicating it, we're going to put two separate pairs down here. If we have a high, for example, something like that over here, and let's just say we find an entry sitting in there. Over here, if it looks something like this, and again, you see an entry, but the high has not been swept over here. If this happens to be cycle 1, this happens to be cycle 2, not 12, 2. You have timed divergence in place. I want you to note that it is not valid if you see divergence between cycles 1 and cycles 4. It has to be consecutive cycles. So when we go back over here, this is January to February, not December to February. January to February. So we're looking to identify timed divergence. There's so many different phrases that this has been coined as. I've heard various different things since the quarterly theory franchise came out. If you listen to ICT, he would call this sequential SMT and things like that. It's just time divergence. Keep it super, super simple. Like, keep it as simple as you possibly can, because it's just identifying certain cycles in price. Let's look at real-time price action right now. There's a couple of things going on. One thing I can see, again, let me just go to a smaller time frame, because what we can see is divergence between this particular high right here and the same high, which is here. If you look over here, you've actually got a high that's been pushed through. So if we're, bear in mind we're on a 5-minute chart. If we actually look at if we just pinpoint the New York AM session cycle, this is the 60 or the 90-minute cycle. The next one would start at 12:30. After that, 12:30 until 2. And then after that, 2 o'clock until 3:30, and then vice versa. So we'd be finishing at 5. That is a 6-hour cycle in the daily cycle, but split into 90-minute cycles. You can see very, very clearly that price action has created divergence between consecutive cycles in price. So this could basically be telling us that price action is likely to sell off. And if we are basically inside a higher time frame point of interest, or if we feel like this is likely to move, and there's a couple of things I want you to understand about this, because this isn't a tool on its own in terms of identifying a definite move lower. But let's just say, for argument's sake, we're playing inside this imbalance here because there's an imbalance that's played off. So if we go to a higher time frame, you'll see there's an imbalance there, for example. So we could look for a short in here. But there's a couple of things now we have to consider. One, where are we in regards to opening price? The main opening price we're going to concern ourselves with at the moment is down here. So we are miles above opening price. That's absolutely fine. You've obviously got the 15-minute imbalance sitting there. So that alone, your stop loss in this situation would go maybe above the S&T. We could look for a 1 to 2 out of this. Something like that could be an option for us to look for a move lower based upon the fact that we are above the opening price and we have divergence between consecutive cycles in the 90-minute cycles. Again, the times have been sent to you in previous lessons, so go and study the times relevant to the session you're going to trade. Again, you can see the opening price of the New York session was here. Price action pushed higher, retested it, and now we're below it, but we're well above the opening price. So that's why we're focusing on the opening price more than anything else. Anything else here. We've got a lot of consolidation between the Dow right now. This is live price action. There's a lot of consolidation there. We'd probably want to see that sell off a bit more. But the overall thing is, if we look at this from higher time frame point of view, we're not really inside a key point of interest level, and we're very, very bullish. So this isn't the highest probable move. But if this was going on now, and this here, let's just say to the left, there happened to be a higher time frame point of interest area, and you got that divergence above opening price, that would be a perfectly good sell opportunity. In fact, this has got 1, 2, 3 rules. I'm not going to say the third one yet, but it's got 3 rules that we need before taking a position. Because the third rule we haven't. I'm going to go into in a bit deeper, in a deeper way, in another lesson, basically. So it happens on the weekly cycle. It happens on the yearly cycles. It happens on the 90-minute cycles. It happens on the 1-minute cycles, the 22-minute and a half, the micro cycles. It happens on all of them. The key thing you have to understand is this divergence now that we're looking for is going to be within a certain period of time. Because if you can identify that, you're going to be a huge advantage compared to 99% of the people who are learning how to trade. I'm not expecting you to get this overnight. You may have to watch this lesson 5, 6, 7, 8, 9, 20 times, whatever. But you've got this information here for life, and you've got the ability to talk to me and be inside our live lessons where we're literally talking about this all the time. So now you understand this divergence. If you need any help, please feel free to reach out. But otherwise, we will go deeper on this in future lessons.